William's question. It's kind of a long one, but it's pretty much what's going on here. So bull put credit and search. I wonder what default's going to come up. Sorry. Okay, the weekly bull puts. Now, I'm going to read William's question. And he says, Michael, regarding the 3-day Apple bull put credit spread, I know you look at 2-week out bull put spreads at around 15% return. Yep, here we are. 14 days out in time, these are the trades I'd pick from. 16, 15, 15, 15, right in the wheelhouse where I want them to be. That's what I look for. Okay? But could you talk about a shorter time frame bull put spread like 3 or 5 days with a goal of approximately half the return, and why you'd prefer your 2-week out strategy versus a shorter time frame? Because this is all based on testing and actual trading from about the middle to end of 2015 to now. I ran extensive tests and tried to develop as best I could similar criteria of this fashion. I tried 1-point spreads 1 week out. I started with 1 week out spreads for the testing to see what my returns would be. Going using the historical testing tools, what could I expect my return and my win rate be with a weekly series? Because why? Because we know mathematically that if you sell week by week by week, you're going to get a better annualized return than month by month by month. That's obvious. And selling month by month by month, you're going to get a better annualized return versus selling 6 months out, getting a higher premium. This is why we go back to whenever we buy, when we're talking about calendars, the long call on the calendars, what we just saw with the theta decay, and the Marion put, we're always going 5 or 6 months out in time. Because yes, we're paying more up front, but it's a lower cost per day. And you don't experience the time decay as rapidly as you do buying shorter term options. All right. So did the 1 week out test with 1 strike, compared it to the 2 week out with 1 strike, and whoa, the same 18, 19-month period, same stock criteria, adjusting a little bit for premium but keeping the same return. Over that first initial 18-month period, the 2 week out spreads performed better. Then I extended the strikes to 2 points, 2.5 points, and the 2-point spreads or higher outperformed the 1 strike apart. And then I would start trading this technique. The one I found that worked the best for me over time with the highest return during that period, both trading and testing, was this cycle. Going 2 weeks out, 2 points apart or more, no dollar strike, keeping an 85 probability or higher, and targeting 15% return, 14.9, 15% return. All of those tests were done with allowing it to go to 100% loss or not, where the weeklies usually end up being negative if you allow 100% loss. But then I started stopping them all at a 50% loss. We wouldn't allow more than a 50% loss on each position, and the 2 week out performed better. Okay? So let's take a quick look here. I'm just going to make some changes. I'm going to keep the same strike difference because that's fair in this example. I'm not going to lower the strikes, because if I lower the strikes, then I have to compare it to a 2 week out and lower the strikes to 1 point strike difference. So we don't have the time. It's already 535. I'm going to keep everything the same, including the probability. What do I have to do? If I'm going to shorten it to 1 week, I have to negate this range out of the money, because going 3% out of the money isn't going to give me the credit I want for the return I want if I'm 3 or 4% out of the money on most positions. Some it might, but very few. So I've got to let this be 1% out of the money. We're going to say a return of at least 7%. You'd mentioned 7.5. Let's go to 7, William. And I've got to take this down to maybe 9 cents. Can't have 2 decimal points in there, can I? Let's take it down to 9 cents. And 1 to 8 days out in time. Okay? Let's run the basic search for next week, the 24th expiration. Okay, so here's, oh yeah, so right away I wouldn't touch this. You know why. I wouldn't touch Moderna. I know it's been rocketing all over the place, but remember, it went up to 85, came back down to 80, and did that. I traded this at 33, wrote it up to 67, saw it fall to 56, and got out again at 65 or 66. I can't remember. But Domino's is a good one. 390. Excuse me. I'm laughing at the price change. 390 And we see we can sell a 370 put, maybe $1.20, and buy a 365 5-point spread, pay about 65 cents. So 58-cent net credit, a 13% return with an 87% probability for a 1 week out trade. That's great. But what's interesting, we're 20 points out of the money. Stock dropped almost 20 points today. That's kind of fascinating. And here's one where you're exactly 30 points out of the money on Netflix, and it dropped 34 points today. I'm not saying it's going to drop 34 points on Monday, but this is one of the things you give up going shorter term. Although we have a high probability that we're searching for based on the historical time frame and the movement of the stock leading up to this point, it takes into account the days. You're actually much closer to the strike price. But see, here are the ones down here that are 7.5. Let's just target your half point. Let's make it really strict. Let's go 7 to 8, okay? Excuse me, ladies and gentlemen. Now, we're going to do this real quick. Okay, so 7 to 8, still good, 85, 83% probability. Apple, that's not bad. 20 points out of the money. Might be something Sam would look at. No offense, Sam. I know you've already got your positions in. I'm just mentioning there. That looks like a decent structure. Maybe a 360 might be a little bit better for a 5-day trade. But in any case, NVIDIA, 25 points out of the money there. All the 7.5% with a good probability. All right, save. 1 week out, 85 prob, half return. Okay, let's save that search. Now, you know this takes some time to do it when we're on the webinar. I don't know if I'm going to be able to do it, William, but now that I've saved my search, I can go into the back test, Smart History Excel, and we can't take March, February. We should probably take January. We should probably go back to January. So yeah, bullput credit spread, excuse me, January. And I'm not on my account, so let's take June. June's a good month. Yeah, I didn't want to take April anyway because we know it was meteoric and the volatility was still high. So every a lot of bull put spreads had extremely high. Your 1 week out that you're talking about criteria we're looking for, if we didn't limit the return, would have probably been 15 because I know my bull puts in April were closer to a 28 to 30% return with the same criteria I used because of that increased implied volatility. But let's go to June. Day 1. I don't even know if that's a Monday, but let's just go day 1. And we'll go 1 week out, 85 prob, half return. Now, it's going to take a while because right now in the background, we're loading up all of the data for today for the historical table, so it has to interact with every historical table, and it's hard to run the historical screen. We're going to try to do 1 or 2 just guesses just to see how it performed. Well, it probably performed pretty well in June. That's why I took it. But again, what I'm going to have to do long term is compare this idea, which I've done, haven't done it into 2020. Okay, so what I should have done too is added another column. I'm sorry, I should have added in the percent out of the money so we could see the average percent out of the money. But anyway, let's just calculate the group results. We had some good results here. Lamb Research, 270 to 250, 250, 327 to 312 on the short. Home Depot, 10 points out of the money for a 4-day trade. Spotify was 12 points out. 5 points out for Caterpillar. 19 points out for Adobe and 12 points out for Boeing. Okay, so I hit calculate group results, so it's going to take these to the 4-day expiration, give me a success rate as well. Okay, well, like I said, it's going to take a moment here. Oh, no, William, I know. I just thought it was funny. William says, yeah, both Domino's Pizza and Netflix had earnings yesterday. That's why they had the big drops today in that case. So, sorry, he says, that's not normal. I know. I just thought it was ironic that it was 20 points out of the money and it fell 17 points, and the other one was 22 points out of the money. It fell 24 points. That was why I was chuckling. I knew it wasn't there. All right. So one of the, let me backtrack here. One of the main reasons, oh, shoot, sorry, resources. One of the main reasons that I stuck with this, William, this two-point spread out, is because that's the one I successfully saw that had a 15% return. I could cut my losses to 50% because I was starting further out of the money. On some of these weeklies where we're not as far out of the money, even with an 85% probability, these are some of the days I saw this disasters happens to the weekly series. You remember February 5th to February 9th, 2018, the first talk with the China tariffs, when the volatility spiked, not nearly as what we saw a couple months ago, the volatility spiked and the market crashed. I had three bull put credit spreads coming up to expire that week. Netflix, TXN, and why do I always forget the third one? It's a two-letter one. It wasn't Bank of America, it wasn't BA, it was something else. It wasn't GS, Goldman Sachs. In any case, in that instant, I had 3 days to go to expiration, and I was still profitable the day, 4 days to go to expiration. I was still profitable going into that morning. When the market fell down, all three of those positions hit a 50% loss. Had I been doing a weekly that wasn't as far out of the money, after the first day of that week, February 4th or whatever, when the market was normal, open positions, that next day, because I couldn't be as far out of the money, all three of those positions would have been a 75, 80% loss. Why is that important? Because if I meet my goals with the bull put spread and 33% here, if I'm able to achieve the 85, 80% success rate with a 15% return and keeping the losses to 50%, well, I'm still meeting my goals. Here we're at 86. I want to get to 83. There we go. Even at 82, after 100 trades, this is more what I'm looking for, but hey, I'd still have a good return. I cut this down. Cutting this down into weeklies, looking for an 85% probability and taking half the return doesn't mean you're going to win more often at all. You're still going to have roughly an 85% success rate. So now you're seeing a losing track record, okay? And you'd say, oh, well, you need to curb this to 35% or less. The loss limit has to be only 35%. It can't be at 50. Well, now you're going to be closing out trades more often and more frequently. And if you allow this to go higher, if you allow this to go to a 65% loss because 1 week out you were less out of the money in that case, you're almost bankrupt with an 82, 83% success rate. Where do you hit a profit? I think it's at 96. Oh, there's 98. Okay, 91. Right at about 90% success rate, which, you know, Andres said he's achieving with his one-day trades. Okay, so you say, well, curb this again. Well, the more you curb that, the more you lower your loss limit to close out of the position. If you hit a 25, 35, 45% loss, the less likely you're even coming close to this 90% success rate. You're closing out positions much more often. David, I think I just answered that. That's where I look for that 50%. I have other triggers that are mentioned in some of those webinars, looking to stop the position if it's the 1% stop in that case as well. If it reaches within 1% of the short put strike, for example, as well. That's what I'm looking for. Okay, so let's just go back now. It looks like it loaded. It did for a moment ago. In this case, I ran it on June 1st. You had a 100% success rate, which makes sense, with an average of 7.4% return for the bull put spreads. Okay, now we're just going to take, this is probably not even the best, this is obviously not the best comparison. I'm going to have to run this over cycles, maybe even over a year. I'm going to take that search we just created, and I'm going to take mine, and I'm going to share with you the results. But I have all of this data already compiled of 1 week out, 1 point spreads with a 70% probability, 75 to 80, 85 to 90, which worked best consistently over various markets. Here's my bull put weekly on the same day, but naturally going out 2 weeks out in time, which gives us more time. Let's calculate group results, and that's going to take time as well. So, but here you had for the 1 day out, 4 day trades, 1 week out, William, 4-day trade, opening on June 1st, 100% success rate, and very easily hit your target of 7.5%. Some slippage because these ones here hit full profit, but they're a little bit below. Okay, so yeah, you've got to cut the losses naturally. Yeah, that's what I've noticed, and that's where it hit a problem there, William. Okay, the comment William made, we just kind of talked about, but I'll review it again. He says, it makes sense about cutting the losses. That's kind of imperative. It would seem that with a 1 week out expiry, if the price moved against you, there would be little time to cut the losses to 50%, as it would probably be a greater loss. That's what I experienced. You know what else is harder? In the example that I did for you, I kept sort of the 2-point spreads or higher. Good. That's a great example. And you're talking about a 7.5% return, which means what? We were talking about half the net credit. Okay. But annualized, we know if we get this on a consistent basis, the 7.5 or the 7.9%, you're going to perform better than my 2-week out spreads. If I'm getting 15%, you're going to get a higher annualized return. That's assuming 100% success rate. We're not going to have that. We know that. But what does this also mean is taking half of the credit. That means that if I did take a 50% loss on this 2.5 spread, this 2.5-point spread here, and for the 7.9% return, half the credit, if I took a 50% loss on that 2.5, oh, this is a 5-point. If I took a 50% loss or 250, I've wiped out close to 17 to 18 trades. Whereas with the 2-week out spread, I got a slightly higher premium. If I take that 50% loss of $2.50 on this 5-point spread, I might only be wiping out 8 or 9. So in the long run, when you do take those losses, which we saw might happen 17% of the time, 15% of the time, on a smaller credit weekly series, you're getting much lower. So, okay, June was great for both of our bull put searches, 15 out of 15, 100%, 15.2% average return, and that's for the 2-week trades. So you see, both of these would have worked out extremely well. I was trying to give you, I don't know, I was assuming one of these on the 2 weeks and the lower end here might have gone against me, but they didn't. It was a great cycle in June. But now I've got to run this test for you a little bit more over a month or 2-month period. And this, oh, here's the other great point Sam brings out. In a 1-week spread, there's no room for adjustment. It's pretty much gain or loss, and that's it. Now, you can always say, oh, well, you can roll out further out in time, but you can't roll out to the next week to repair it. You're going to have to go further out, 3, 4, 5 weeks at a time. Same with me. If I do decide to use that one type of adjustment, the one of the 8 on the bull put credit spreads that I discuss as potential rolls, or just closing it if I hit a 50% loss. But if I do decide to roll it out, I'm probably going to have to increase the strike prices and increase the time as well. That's what's dangerous on a stock that's moving against you, because if I just roll a bull put to a bull put, I could take a much higher loss further down the road because the stock's not moving in my desired direction. David, to answer your question, you've already heard me mention some of those. What about taking gains? I take gains Friday expiration, I hope, for the full profit. I don't close early. When you hear investors talk about closing for a 50% gain, mostly they're referring to sort of the out-of-the-money debit spreads we talked about last week, where I might be buying an at-the-money call or slightly in-the-money call and selling an out-of-the-money call as a debit spread 30 days out in time. So it has a lower 1-to-1 or 2-to-1 risk-reward ratio. And if the stock starts to move in my direction, I can close that spread for half of the max expected profit. I'm going to close it out and move on. Okay? If it moves against me, then I might close it out too. With the credit spreads, I don't target a 50% gain. And you saw why. Because during testing and actual trading, what usually happens? When I just talked about, when I talked about the 13, 17% of the times I'm wrong, is because the market suddenly fell against me. What doesn't that do? That doesn't mean that if I close these positions and hit a profit, half of the profit early, I increase my win ratio. I still lose the same 15% of the time because it happens on those unexpected days that we can't control that's not related to the stocks. And you can see here, if I keep my losses to 50% and I still keep my same 85% win ratio, because closing early doesn't help that in the bull put credit spreads, the shorter term, 1 week out and 2 weeks out. Closing early is more for 30 days out and 40 days out when you have a more to 2-to-1 or 1-to-1 risk-reward ratio with those at-the-money spreads. With these, you want to try to achieve max profit at all as much as possible. And again, closing early does not negate the loss ratio, because the losses happen on those unexpected days where, boom, Dow's down 1,500 points. SPY's down 800 points. 2 weeks later, boom, trade war with China. VIX spikes up to 45, and we're down 7%. Your spreads are at 50% loss. They wouldn't have been able to have been closed early. They wouldn't have seen that decay as we just talked about earlier in the presentation yet, okay? So you can see here, making 7.5% when I'm right, keeping my losses to 50% of the max expected loss. and still being right 85% of the time, at one point I might look really good, but long term, it's not going to give me a profit. Here I got to be right 89% of the time to see the type of profit I'm making. At 85%, I'm losing money, almost 50%. That's why the math has to make sense. The numbers have to make sense. And that's what I started to analyze, and then I started to find a good set of criteria, not just, hey, anything with an 85% probability 2 weeks out in time is going to work for any spreads. Now you've got to tweak all the stock criteria, technicals, and fundamentals, and that's what I've been doing. So I try not to take the gains early on the credit spreads because it's not like an out-of-the-money debit spread where you can close early, and you might want to close early as well. Okay? All right. I had a question from a while ago that came in, and it was kind of related, but Vin says, your view on NKL July 24th bull put spread, 45-44 credit for 10 contracts. I wouldn't touch it. Sorry. I'm not even going to look at it. I don't have enough confidence in NKLA, even though it's as high as it is right now, and those prices are so far out of the money. Oh, they're not. Okay, I thought Nikola was very high. This thing is way too volatile. It swings way too much. A 50% return with a 60, 70% probability on this stock that swings wildly, I don't think it's worth it, okay? You want to make a good premium. You want to make a consistent premium, as we've been talking about, Vin. You don't want to look for the highest premium bull put spread in a 5 or 7 day period. That is a recipe for disaster. You want to look for the right stock technicals and fundamentals. This is below the 20-day moving average, negative MACD. I'm not entering this as any bull put spread at any strikes. Sorry. That's all I have to say about that for me personally. It's not in any trend that I would use for a bull put credit spread. The premium is irrelevant if the stock's not moving in the desired direction, so I wouldn't even touch that. Okay? All right. All right, so Sam just offered that on his 3-point spreads there, he's talking about, I'm sorry, my 3-day trades, I only take those trades below the support, so even Apple fell from 400 to 384, it was okay. I'm sorry there. Oh, this menu. Okay, it was below the 380 support level. Okay, there you go. All right. All right, so William says, Mike, thanks for the detailed explanation. Makes sense. You're very knowledgeable. Well, yeah, and I've been doing mostly studies on bull put spreads for the past 4 years now, 4.5 years. And, you know, I still keep up with it because I still have to know in my head. There are cycles. Now, William, there's cycles with everything. Don't get me wrong. We could probably take that June series. I could probably run those this weekend or early next week and just run June. And your 4 weeks of June, 7.5 to 7.7% return weeklies that we just basically created using the same technical and fundamental we use for the 2-week out bull put spreads, you could easily beat me in June. That trade could probably, at the end of 4 weeks, will probably beat me in July, maybe. We'll see. But we're talking about long-term performance. What I tried to do was to make it easier for customers, similar to what Ernie did with the picks of the day for the cover calls and the naked puts, is the idea of what do we feel confident is the best criteria that will keep investors out of trouble, where if they did just go in and start trading these in a reasonable market condition, that they'd have a pretty good rate of success and a pretty good overall return over different markets. And this is the one I found that appeared to be the best. But everything's cyclical. You're going to be able to go back in time and find series where a 1 week out, 1-point spread over the course of 4 to 8 to maybe 12 weeks outperformed what I'm doing. Over the course of 3 years, that's going to be a different story. So it's give and take. What's in the moment? What looks good to you? What are you comfortable with? David says, when do you open the bull put spreads? Mondays? Yes, that's correct. I usually look to open my bull put spreads on Monday, mid-morning to early afternoon, after everything else has calmed down a little bit. Right? All the activity, that whatever news came out over the weekend and so forth is there, okay? Oh, yeah. So, of course, naturally, what I said earlier, Sam is commenting on in Apple, I'll not do the trade that he's talking about, the 3-day out bull puts. I'll not do the trade in earnings going to pass for that week. Absolutely. Not the structure to use. Bull puts, directional spreads, not the structure to use, okay? Howard... Howard is just a basic, that's not basic question, it's more of a trading question. And keep in mind, I'm not saying that the bull put credit spreads that I show there should be taken as recommendations or suggestions. I don't take the top 3 or top 4 that come up in the list. I still research and analyze each one to show exactly what we just sort of talked about for Vin. If I pull up that first one and I don't like the stock movement, I don't like the fluctuation, I don't like the MACD, I'm just going to ignore that first bull put result that I'm looking and move to the second one. And then I'm going to also look at the news. Is there any news that has come out recently that makes me nervous to enter that position? If I see something, then I'm done with the second trade and I'll move to the third. This is a whole nother aspect. Howard says, how many spreads can you manage in bull puts? First of all, I don't want to fall into this trap of suggesting I'm recommending how you trade because I'm not a financial advisor, but I don't look at it as how many trades. I look at it as I'm only allocating 15% of my total portfolio to bull put spreads because I know that I can lose 50% of that value in an instant, which means what? 7.5% of my total portfolio. I'm comfortable taking that with the unexpected risks. So only 15% of my portfolio is allocated to bull put spreads. A good number is between 10 and 15%. 20% I feel is a little bit too high, in my opinion. Any vertical spread or any option strategy that could result in a potential 100% loss that moves against you should not be traded with more than 15 to 20% of your total portfolio value because of the unexpected that we've seen 12 to 15 instances of in the last 3 years, going back to 2017. Okay? I'm not trying to be political about that number. I'm just saying, yeah, the black swans, that's what I'm talking about, Sam. 6 out of the 12 months in 2018 were negative. That February 5th through 9th crash, the March, right after that, March 20th to April 5th, I believe, that it happened again on August 5th. Remember that disastrous October to November we had at the end of the year, followed by that disastrous December. The year before that, there was 1 or 2 drops, but not as severe as what we saw February 5th to 9th. And then there was 1 or 2 in 2019, and we know about the big one that lasted 35 days in 2020. So yeah, we're about 9 to 10, I think, black swan events, significant, that happened that took not just owning stop, but could have taken a whole spread portfolio down 50% or more if you didn't catch it at the 50% loss. You could have seen 80% losses 3 days later if you didn't stop it at 50%. Okay? So Howard, I'm not avoiding your question. What I'm saying is that I'm allocating X amount of my portfolio, 15% of my portfolio, to bull put spreads. And then that helps me dictate how many trades I should have open, which for me is usually 3 or 4. At the same time, I've got 5 or 6 married puts open. I've got a few calendar spreads open. I've got a couple straddles for earnings open. I've got a couple regular collar spreads open as well. My max is around 17 positions total. And that's why I have the allocation set the way I do. That works for me. You have to find what works for you. Okay? That's the best way I can answer it. What makes you the most comfortable? And for me, with that portion of my portfolio, and to keep the allocation I want for the returns and margin requirements I want, 3 to 4 trades with a 15% allocation of my portfolio is where I'm comfortable with. That's me. You could take 15% of your portfolio and do 10 positions, and you'd still probably do pretty well, Howard. Okay? But thank you, Sam. That's just what I was going to. I'm watching Sam's comments come in. Position sizing is important. And if you're doing 15% of your portfolio, you naturally, why do I like having 3 or 4 trades open, Howard? You can almost see it right away. And that's because of even if I don't catch one, even if one of those positions goes completely against me and I can't catch the 50% loss I want to take and it hits a 100% loss in that bull put spread, that's only 5% of my total portfolio. That one trade is 5%. I can withstand that and continue to move on. Position sizing is key. Okay? All right. All right. Oh, good. Sam says his spreads are only 10% of his account. Now, that's good. That's pretty safe, actually. That's really safe, really smart. Okay. Sam also added when the market dropped in the COVID-19, SPY puts from $3 to $8 in the monies, which faded away in 2 months. Okay. Yeah, so I'm going to take a look at that as well. That's also another reason to look at the contra ETFs for total market hedge in that case also. All right, we're at 6:05 p.m. Eastern Time. I'm pretty sure, I think I got every question that came in with some allusions back to the other questions that we referenced earlier. If anyone has a last-minute question, go ahead and send those in. Or if I didn't answer one of your questions fully, go ahead and send those in. I don't even know what screen I'm showing right now. But that's not the right screen I wanted to show. That's much better. All right. I just wanted to remind everyone that what I just discussed there, look, today's material are my thoughts on your questions designed for educational purposes, increasing investing performance, and options knowledge. Any stocks or options discussed today should not be taken as direct trading suggestions or recommendations. Options do involve risk, may not be suitable for all investors. Just like these days we say practice social distancing and wear your mask, practice proper position sizing and know your stops. All right, when you're trading, when you're back inside in your own place, still apply those rules. Practice proper position sizing, not just social distancing, when you're in your trades there, because that's what was really key. If you invest too much into a given strategy, you can have it come back to bite you very, very quickly. Now, if you like some of the tools that we saw today, we've got a chance to look at some of the historical backtesting tools, ran a couple searches. We looked at the portfolio to see if we had any rollout opportunities, and then we used the custom spread tool for other management. But if you haven't yet, just go to powerop.com, enter in your name and email address, and you'll have full use of the Power Options site for 14 days. After that, our subscription levels start at $45 per month, but that's just for the end-of-day data. We do, of course, offer real-time data and access to the historical tools at different prices. Well, we already talked about the webinars page. You can go there and look at a variety of webinars for option strategies and management techniques, or just go to YouTube where we post most of the videos. Sometimes we'll only post one or two of the videos from a previous Friday session or for other materials on the webinars page, but all sections of the Friday discussions broken up into more digestible parts are always available on YouTube to the public. You can always check out the blog as well. Oh no, I just clicked the link, didn't it? All right. But if you think of any questions at any time, remember, just send us an email to support@powerop.com or support@radioactivetrading.com over the weekend. Call us during market hours at 302-992-7971. And of course, I want to remind all of you current trial members and subscribers, you can, get out of there. Current trial members and subscribers, you can schedule that coaching session at any time, essentially a 35 to 45-minute phone conversation with myself or Ernie, walk you through the tools and answer any questions that you have. All right, here. So David says, thanks for addressing my questions. Thank you, David, for your questions. I appreciate it. William says, thanks so much. Great session. Enjoy your weekend. William, thank you. You enjoy your weekend as well. Of course, David, enjoy your weekend too. Sam says, yeah, I enjoy these Friday sessions so much. Thank you for that, trying to make us better traders, the supermarket of the webinars. All right. And then, Sam, you have a nice weekend as well, and practice, safe distancing. Vin, you have a great weekend. Thank you. And Andres as well. Thank you for your question, Andres. It was very good. I enjoyed the questions immensely. They all sort of fit nice into each other. Seems like everyone's got their mind on volatility, on earnings, and maximizing premium with volatility. But I think we showed some of the warnings about doing that, and some of the risk that can come with that as well. You all take care. We'll see you soon. I'll let you know as soon as these webinars are parsed out, put into their proper little sections, and posted on the websites. Good night.